Hi, good evening. Welcome to our weekly market outlook. Today is 18 August 2014. So, as usual, if you can hear me, just give me a yes so we can start as normal. Very good. I saw lots of yes coming. Okay, so just a brief introduction of our today's webinar. It's the same as usual. We have four parts of the webinars. The first part, we will let you know the recent economic releases and the fundamental stories, what kind of thing could drive the market. So for this week, probably I would say there's quite a few important data probably will affect the currencies like the Eurozone and China fresh manufacturing PMI, especially the Eurozone, is pretty important. Also, China, I think it's also pretty important because after the bad data yesterday, so the people want to know that whether the momentum will be extended to the third quarter. So also besides that, we will have the Jackson Hole meeting, which this meeting usually the central banks, especially the Federal Reserve, would tells you some policy direction they want to move for the near terms. So now markets pays pretty close attention to what Janet Yellen is going to say, whether she's going to be dovish or she's probably will change the tones, to be a little bit hawkish. Let's see what happens. So the second part, we will have the this week's events. So every week we have some pretty important events. So for this week, we will also let you know what kind of data probably would drive the market. And for number three, we will have the live charts. So from the live charts, we will let you know what kind of a price momentum is. The price based on the current momentum is likely to go higher or likely to go lower. In the last part, we will have the Q&A sessions. So if you have any questions, just type in the box. So by the end of the session, I will answer all the questions. So let's start today's webinar. Janet Yellen's speech. So it probably will be the central terms is going to dominate the market from maybe as early as from tonight. That's why you see US dollar, it's not so strong compared with previous few sessions. And also you see last week, the dollar also not very strong. So let's take a look on the last week's events. We don't have lots of important data last week, but all the data I would say come out is pretty important and will have the coming influence, will have some impact to the following a few weeks at least. So first is German ZU fell sharply to 8.6 from previous 27.1. It's a very drastic drop, and it tells you that the largest economy, the momentum was not so strong. So if the confidence continue to fail, that could bring the manufacturing activities, other economic activities lower. So if that is the case, that probably will suggest more stimulus probably need to do by the ECB. Of course, that's a negative news for the euro. So the message here is pretty clear. Also, from a Bloomberg survey, that's why I see the news this afternoon is less and less people actually have the strong confidence that the loan take up from the TLTRO, the ECB program. So that means probably because of the economy going down and the confidence also going down, probably the demand for the credit was not so good. And if that's the case, it's also pushed the ECB probably need to do QE if they want to reverse the current falling momentum and inflation. So all in all, that's set up a very negative tone for the euro dollar, because if more QE ECB doing, if the expectation getting stronger, then the euro will be weakening further. Second is the China lending data in the industrial production also fell. That's especially the lending data. The lending compared with June, it was fell about almost 100% on the aggregate basis. Also, the industrial production also fell slightly from 9.2 to 9%. So the lending data is very important in China. The reason is, number one, the economy is very depends on the credits. So if the credits fell based on the historical experience in the past 2 to 3 years, the growth is also likely to fail. So if we don't talk about the stimulus, right? So if the Chinese economy fell, so means the Aussie and the Kiwi might also fail. But now why the Aussie Kiwi can still hold the momentum? The reason is because people expect the PBOC and the Chinese official probably need to will launch more stimulus, or at least keep the stimulus ongoing, to make sure the second half of the year can hit about 7.5% of the GDP target. 3 is the US retail sales also fell to 0% from previous 0.2%. So the U.S. economy, 70% is consumption driven. If the retail sales is not very decent, it probably will suggest that the Q3 GDP will not be so strong compared with Q2, and that probably will be a consensus from now, because the Q2 GDP is really too strong. It's about 4%. The Eurozone second quarter GDP growth is flat. That is same as our expectation. But why German growth contracts 0.2%? So everything you see from the previous week, everything like fell. Right? So that's a reason the dollar also weakening. It's a bit different like last time. Well, last time everything fell a bit, risk off, then the dollar would probably go stronger. But now, why the dollar fell after the economy data fell is because if the global environment is weakening, it probably will also, it will also probably suggest the Federal Reserve will spend longer time to put the interest rate at 0% level for a while. So that's the reason you see a weakening dollar. So let's look on what happened this week. This week we have the RBA minutes, RBA meeting minutes. Tomorrow, it's pretty quite interesting to look at it, because the reason is, the Australian unemployment rate is crossed above 6.6% to 6.4%. So that is telling you that the Australian the labor market is pretty weak. So if the Aussies remain so high, whether the RBA will going to do anything. So from this meeting minutes, it probably will give you some discussion or give you any insights of what have the RBA governors and the rest of the committees are talking about. So also tomorrow night we will have the US CPI. Although the US CPI is it's not the Fed gauge inflation index, because what they're looking at is the PCE, but still the CPI inflation will gives you a idea that whether the US inflation will continue to go higher, or probably will maintain the same level, or it will start to go lower. It's a very important information, because the US PCE now stands as 1.6%, only 0.4% to the Fed's target. So if the CPI tomorrow continue to go higher, it suggests the PCE, it might go to 1.7, 1.8%. That is not so far to the Fed 2% target. So if that's the case, you will see the expectation on Fed to raise the interest rate will become earlier. So dollar will go higher, and also the US Treasury yield will go higher. In the FOMC minutes, that probably we will not expect lots of things from there. Most likely, I would say the July FOMC minutes will be pretty same as June. So the market will still focus on the Jackson Hole meeting, which is in start from Thursday, but Janet Yellen only speak on Friday. And on Thursday also pretty important, because on morning we have the China flash manufacturing PMI. Also Eurozone will have a flash manufacturing PMI. These two data are very important, as both of these two economies are still pretty decent in the first half of the year. So after people suspect the Chinese economic activities might going lower, so they want to use the August data to confirm. If the August manufacturing PMI continue to go higher, then then people will say some weak data in July probably will be just a one-off event. So they will still consider Chinese economy in near term will be pretty stabilized. That would be benefit the yuan as well. As you notice that since you can trade the yuan in our platform, you can notice that the yuan is pretty strong at this moment. So Eurozone flash PMI is also pretty important. Now Euro is still below 1.34. So if the Eurozone flash manufacturing PMI go lower again from the last week or from the last month, then the expectation on the Mario Draghi to do more will be increased. So Euro will go lower. So Friday, I would say probably would be the most important day of the week, as you will hear what Janet Yellen speak in Jackson Hole meeting. So the topics is about the labor market. So the stuff. So from the labor market perspective, it's the condition direct links to the Fed policy. So that would tells you that what kind of policy the Federal Reserve might use toward the end of the year. We have a macro summary first, as usual. So let's look at the currency performance last week. You can see that after dollar was weakening a week before. Oh, sorry, after the dollar is weakened, it's weakening a week before. So now dollar tend to be strong. Dollar a week before is pretty strong, but last week you can see that most of the currencies outperformed the greenback. So it was pretty weak. You can see only two currencies are weakening against the dollar. One is Japanese yen. But why Japanese yen is weakened? Because the Ukraine and Russia conflicts didn't escalate further. So that's the reason yen as a safe haven currency dropped. Of course, number two is sterling weakened is because of the Mark Carney, the BOE governor, mentioned that probably the market is a little bit running too fast of the BOE rate hike expectation. They probably will not hike this as early as next quarter. They probably still will look at the data, because it's quite a surprise to us. Mark Carney also talking about the wage. So when Janet Yellen talking about the wage to make the policy accommodative, so now Mark Carney also talking about the wage. So I guess probably just the BOE, the Bank of England, they don't want the sterling too high. So that's the reason. And you look at the dollar index. The dollar index is pretty flat, but you can see that the momentum was pretty weak because most of the currency outperformed the greenback. US Treasury yield is lower, but dollar yen moves higher. So what does that tells us? You have to consider about a little bit of the GDP, the Japan GDP, right? So I still would say the dollar yen moving forward, it will continue to move. It will be continue to move toward the same direction of the Treasury yield. Why last week there's a momentum that why the dollar yen go higher but Treasury yield go lower? The reason is because the Ukraine and the Russia issue, of course, is not escalate further, but still the problem is not solved yet. So at this moment and before the Jackson Hole meeting, people are expected Janet Yellen probably will give some dovish language. So that's why Treasury will go lower. But why dollar yen go higher last week is because we hear a very disappointed Japan GDP figure. So in the meanwhile, people are thinking that maybe toward the end of the year, whether the Bank of Japan will launch further stimulus. So here is the thing. You can see that dollar yen is still maintained the same. In 2014, the price is between 100 to 102, but you see the GDP figure. The GDP figure was about from 1.5% in first quarter. In the second quarter, the GDP suddenly go to minus 1.7%. So it tells you because the tax hike was starting from beginning of the April. So in order to offset those negative impacts, the people will want to hear what kind of thing the BOJ might do. So if they do more, the yen will weaken, so dollar yen will go higher. So that's the reason Japan GDP slump fuels the stimulus hope. US equities also moving higher after the geopolitical risk erased. You can see there's two lines here. One is the white line is the S&P. The other is the MSCI global indices. So you can see that the US equities was still pretty strong. The equities selling off in the past few weeks is mainly because of the Fed tightening fears. Number two is a geopolitical risk. So at this moment, at least from now to, I would say from now to end of the year. End of the year means November, beginning of December. I don't see lots of language or policy stance shift from the Federal Reserve. That's what I think. So I guess the equities might continue to go higher as long as the economy stands firm, right? But if the economy drops, people want to see combined with the fundamental and the policy stance to see whether it is justified to buy the price higher. But at this moment, I would see the price is still pretty stabilized. And the geopolitical risk, like what I say, is it's very hard to measure, what's the real impact. But so far, everything we still prefer to believe that the negative consequences, it should be still pretty limited because of the geopolitical risk, right? So all the countries, they put a sanctions. Lots of countries, they put a sanction on Russia, but the main purpose is to penalize the Russian economy, but not to make their own economy suffer. So that's still the main theme of the why those kind of a country want to impose the sanctions. So now we go to specific topic, right? We're talking money could be in China now. So when you are very obsessed with what kind of direction of greenback will go, what kind of direction euro will go. So since our platform now have the Hong Kong equities and the dollar CNH, the offshore yuan trading, you can trade in our platform. So we just want to share a little bit of what happened in China. So Hong Kong index is pretty, not 100%, but it's pretty in line with the Chinese equity, the Chinese economy. So if you want to trade Hong Kong indices, it's called HSI. I think in our platform it's called HK40, if I'm not wrong. So you probably need to understand the Chinese economy a little bit, whether it's a good time to buy now or it's a good time to sell. But I think the chance is still there. So you can see that after the government, okay, the other reason is why sometimes the Chinese investment is not so difficult. Compare with investing in other G7 countries. The reason is because the economy, although it's getting more and more open, I mean the asset classes, but it's still pretty policy driven. So it means to say that if the government doing some stimulus or make the monetary policy to be quite accommodative or quite easygoing, usually it's very good for the economy and its asset classes. So vice versa, if the government wants to tightening, you can see the price react will be also quite fast to the negative side. So you can see that since beginning of the April, when the government trying to talking about we want to stimulate the economy to make the economy at 7.5% change. So you can see the two line here. One is the dollar yuan. So dollar yuan, you can see that is from 6.25 all the way to 6.1440 today. So all the way one way weakening of the dollar yuan. So so yuan is getting stronger. So because now yuan is more market based. If the economy is getting better, so yuan will get stronger, right? So the other, you look at the Shanghai Composite Index. This index is even outperform the major indices like in Europe, in US. So since you see from April, the bottom is seen around the 2000 level, now all the way to 2239. Especially you see there's a huge rally since a few months ago. Since a few weeks ago. So we will also share with you what happens. So China monetary losing test effectiveness of the credit. That's one of the article Bloomberg talking. It's a pretty long article. So I just taking something simple to let you understand what kind of condition we have. So this index is called Bloomberg Monetary Condition Index. If the index is moving higher, it tells you that the current monetary condition is still quite easygoing. If the level is lower, it tells you they're going to tightening, right? So you see the 2012 is not very good. 2013, there's some period is pretty low. In the 2014, beginning of the year, you can see the monetary condition also not very good. But so that's when the time the economy not running very well. If you're talking about China, their asset classes is not so attractive. But if you're talking about the overseas assets like Aussie, Kiwi, at this moment also not very attractive. But you see now the price is the level is pretty in the higher side of the 3 years range. So it tells you everything is still pretty easy going. So if you see this is the thing happen, you can just pretty have a great idea that the Aussie, it's standing pretty high level compared with previous 2 or 3 years. It is true. And also the Chinese equity is pretty attractive. So here is, you can see that the China credit gauge plunged as the industrial output growth slows, right? You can see this is the aggregate financing chart. The aggregate financing was the lowest since October 2008. That has happened in July. But of course, official has lots of reasons say the data is very volatile. But if the data falls too low, like this level, like all the way from 2,500 billion all the way go to 273 billion. It's like don't know how many times fall. So if this is the case, it only tells you that if the government, if you are clear that the government wants to defend the 7.5% growth, they sure will make the policy to become more accommodative. At least I would say the chance is pretty high. So if this is the case, you probably will see the equity price will go higher again, right? And the yuan will probably going stronger again, because the Chinese market is also pretty forward looking. They're not really looking at what thing happened past, but they're also looking at what happened in the future, in the coming few months. So people foresee that in the coming 2 to 3 months, they probably will still see lots of easing measures will carry on. So that is going to support the Chinese equities and some relevant assets. So will the government do more, right? So I just get some very important news from Bloomberg. The data spurred the speculation that the government will increase the stimulus when premium lease growth target about 7.5%. So everyone is talking the same story, right? So also the IMF also urged that the Chinese need to slower the expansion in 2015. But of course, that's the 2015 story. In 2014, second half of the year, the Chinese economy still need to achieve 7.5% of its growth. So if this is the thing, they just need to do more. So on the second piece of the news, you can see the data spur the speculation that the government will increase the stimulus. This is also some people say if your 7.5% growth is at a risk. So PBOC also try to calm the market at this moment. They will tell you that it's not tightening, right? If you see the lending going lower quite sharply, then you should feel that it's a tightening. But now PBOC tells you that it's not tightening, because they tell you that from the beginning of the August, they usually don't make this kind of comments. I mean, after the loan data happened, but now they say it's already running at 30 billion yuan to 30 billion yuan a day in the first 10 days of August. So it tells you that in the first 10 days, the number, it's already reached about 300 billion already. So it tells you the number will rebound very fast. They're just trying to calm you. And the money supply, credit, and the aggregate financing are expected to maintain stable growth in the future, said PBOC. It's very clear to tell you this time is very different. They saw the number going down. They don't say because we are doing the deleveraging. They still tell you that everything will back to the pro-growth conditions. Also, the other person from CICC is a pretty big investment bank. One analyst say the credit number suggests that the probability of the further monetary policy relaxation has increased. So if this is the case, I would say it's a quite a good news for the Chinese equities, and the yuan will also probably continue to go higher. As now the market a little bit have self-fulfilling after yuan selling off. Now yuan just all the way, rebound because people are thinking that the investment in China, probably the momentum is back. And if more people believe the yuan momentum is back, more people will put the money into China. I mean, think about it. If the overseas returns for the those kind of interest rate was so low, the US is still 0%, and the eurozone is still very low. So the global macroeconomic condition, the interest rate is low. Of course, if you can get 3%, 4% interest rate in China, it's a pretty attractive. Shanghai Hong Kong link also spurred the record buying of the mainland ETF, so buying the stocks. So here, I'm not very sure whether I said this last week. Is the Shanghai Hong Kong Connect. It means you can purchase the same stocks which is listed in Hong Kong. Also now the Chinese market players, they can also go buy. So last time when foreign players, they cannot participate in the Shanghai stocks trading. So now some foreign traders, they can also go there to buy. So in Shanghai and Hong Kong, there's a lot of stocks. They have a dual list, but their valuation is different. But of course, the Hong Kong valuation would be much more expensive than the China. So now it gives you an opportunity to buy the shares at a lower price. Of course, lots of people, they want to buy the A-shares market. This is one of the key reasons why the A-share market is so strong in the past few weeks. So this is not only boosting the A-share market, it's only boosting the value of yuan because there will be more inflow. Lots of people might sell their own currency, sell their Hong Kong dollar, sell the US dollar, sell the euro to buy the yuan because they want to participate in this Shanghai Hong Kong Stock Connect. So this is one of the reason you can see that why momentum is still remains, right? So I'm not saying at this moment you should just blindly go to buy yuan, buy equities in our platforms, but you can start to take a look whether the chance is nice for you to jump in to catch the ride. And here you see who is the best, who is the worst. I used from the recent how many weeks, maybe about 3 weeks, right? You can see that in the past 3 weeks, the Shanghai Composite Indexes is the red color. It's rallied about 8% in the past 3 weeks. And because like what I mentioned, HSI, the Hong Kong future, they track the Chinese economy. They track the China prices also quite closely. So it goes up 6%. So US equities was down 3%, right? So in general, for long-term basis, I'm still prefer to invest in the US equities. But like what I say is lots of times, we also need to look at those kind of short-term trading, especially for the equities, right? So currencies, of course, lots of things is pretty short-term, but equities, besides the long-term, medium-term, you still have lots of short-term trading opportunities. So meanwhile, when the funds, you can see is pretty clear, is favor in the Chinese market and not so favor in the US market, so why not we just take the ride on that if the opportunity was still there. So after China, let's talk about the Fed. Right, Fed. I only have two things to say. We hate to guess, but we do not have other choices. The Federal Reserve this year, especially when Janet Yellen become the chairs, people are not very clear about what kind of language she wants to say. Some people say she's behind the curve, but some people say she's doing the right things because we have to be very cautious. But what's the end solutions? So I just take these opportunities in this education platform to share with you what kind of things people are talking about. So in the end of the day, if you want to make decisions, it's easy for you to make. So two views. Here is only two views now. The main two views on the US monetary policy. The first view is the jobs growth is increasing along with the inflation. So, and the jobs growth is increasing, and the inflation also going higher. So she shouldn't use the recession era monetary policy still in place. So the first view is Janet Yellen should make the policy to be less accommodative, at least less dovish. Of course, the second view will be a fragile recovery that still owns its modest gains to the Fed's near zero interest rate. Especially the jobs market contracts are dividing economy watchers on when Fed should start to raise the rates. So that is the case. Also, I believe these two views also make Janet Yellen very headache at this moment, because she both are pretty make sense. It just everything is on her end, what kind of choices she want to make. If she want to raise the rates faster than the market expect, then you probably will see a slump of the equity prices in the near term. The rates will go higher. Then if anything happens, the cost to recover will be even more higher. That's her view. At this moment, that's what I think. So she always mentioned significant slack, right? So what does that mean? Even with unemployment rate rebounding, Yellen also has cautious it still be too soon to start withdrawing accommodation. She will give the keynote speech to the Kansas City, the Feds, in Jackson Hole, this Wyoming, this Friday. So it's total. This is 3 days. But what's the latest testified to the lawmakers was happened in 15th of July, when Yellen said that recovery is incomplete and the slow wage growth signals the significant slack in the labor markets. It's pretty clear that she doesn't want to change her previous view that the U.S. still need lots of stimulus, still needs lots of easygoing policy. So inflation target, this is also pretty important because, as I mentioned just now, inflation, the Fed's target is 2%. So now their preferred gauge PCE was 1.6% in June. That's in June. So now we are waiting to see the July data to come out. Also, the second quarter GDP figure was 4% in an annualized rate. So far, so good, right? Growth go higher. Unemployment, the labor market also improve. Inflation also go higher. So it looks like everything was the best 6-month stretch in a decade. But she mentioned very clear that now the wage growth is the key now. So, now the wage growth is about 2% if you base on the average hours earnings, the 2% growth year on year. So before 2007, just give everyone a background why she says it's a slack. Is before 2007, the average rate is about 3.1%. So of course, we do not expect those kind of booming period in 2007 because that's really a booming period. But what Janet Yellen want is maybe 2.2 to 2.5% at this kind of a range. Probably she would be a little bit willing to raise the interest rate. So one of the strategists in Bank of America, Merrill Lynch, he mentioned that it gives the Fed some time to watch. So if they do make a mistake, the cost is low. So what he trying to give the view is the Federal Reserve is just spending the time to watch whether they should raise now or they should, or should raise later. So they are very patient. At this moment, they are very patient because they don't want to make a mistake, because they are afraid that if they made a mistake, the cost later will be very high. So the other topics I was also read today is also quite interesting. Is don't hike alone. Is Jackson Hole bear warning for central banks? Of course, before the Jackson Hole meeting, Bank of England say we are not rushed to hike. Of course, that is not the case for ECB. ECB probably, they have a more reason to say they need to lower the interest rate, and again, they need to do stimulus. So when the global central banks are not willing, even now the RBNZ, right? The RBNZ also tells you that they want to take a break for the further rate hike. So when the global environment is pretty dovish, I don't see Yellen want to be be hawkish alone by herself. If that is the case, dollar will go higher, and also U.S. Treasury you also will go higher. The borrowing cost will also go higher. So that is, totally not helping the U.S. economy in the near term. So if this is the case, the dollar will remain weak for this week. So that's the pretty likelihood, the conclusion we want to say. But of course, there's a one risk is the Thursday Eurozone PMI. Because if the PMI weak, Euro will go weak, then dollar will become strong, right? So, but still in general, because Jackson Hole probably will be more important than the Eurozone PMI data. So, as long as the Jackson Hole meeting, the tone will be dovish. So this week, I would say the dollar is unlikely to rebound substantially from last week. So when Yellen changed her tone, September or December, right? So here also a little bit background, a little bit schedule to let everybody knows. September there's a FOMC meeting. October there's also a FOMC meeting, but October FOMC meeting there's no press conference. So I don't think in this kind of environment Yellen will be talking something new. November there's no FOMC. December there will be a final FOMC for 2012. So it's pretty fast that in 2014, the key FOMC meeting, we only will have 2 FOMC meeting left already. Wow, times really flies. I just feel 2014 just starts. Now we are, moving to the end of 2014 already. October, most likely, QE3 will be all taper. So after October, it will be left nothing for the QE3. So QE3 is all taper already. So before the QE tapering, I also don't think Janet Yellen will start to talking about lots of hawkish thing. Otherwise, the rates also will spike higher. So August, September, the consensus is most likely Yellen will be dovish. So that is the case. Dollar might stay at the weak side. But of course, if anything happen, it still can rebound very fast. But now it's just the framework we are trying to build in our model. Okay, so after China and we talk about some US, let's go to the poll time. The poll is, just read a bit careful. What do you expect from Yellen this week? Continue to be dovish, meaning she's just dovish, and like last time, as usual, I'm talking about lots of slacks. And the second is change the tone to be more hawkish. Also, you can choose no important message to express. Also, number 4, you can choose even more dovish than expectation. If the first thing happen, the first condition happen, I will see dollar will be going weaker slightly, then equity go higher. If the second thing happen, of course I see the dollar will spike. Dollar will spike. And number 3, no important message, probably market just ignore and looking for the further confirmation. If number 4 happen, dollar will slump and the equity will also rally. So that's the thing happen after these 4 things. Okay, so it looks like most of people still believe that probably nothing will happen this week. Okay, number 1 is continue to be dovish, and that is 52%. 6% choose change the tone to be more hawkish, and 30% choose No important message to express, but we have 3% of the people choose even more dovish than the expectation. So let's see what happened this Friday. If I'm not wrong, it's about 10 p.m. So it would be pretty interesting to watch. So now let's go to this week's events. So tonight, not too many things as usual. Monday usually is quite free, and from tomorrow morning 9:30 a.m. we have the monetary policy meeting minutes. In afternoon we have the UK CPI. This UK CPI also very important as it decides the pace of the how fast the BOE will raise the interest rate. So previous is about 1.9%. So forecast is 1.8%. So if the inflation is fell below 1.9%, probably you will see the UK the sterling will slump again. If you see the inflation moving higher, then you will see UK the sterling will be higher. So tomorrow also after night, 8:30 p.m. you will see the US CPI. This CPI month to month. So it's about 0.3%. So people expect the inflation to be a little bit lower, but CPI and the inflation data don't look at month to month, always looking at year to year. So Wednesday morning, we have the RBA Governor Stephen's speech. The rest of, it's not so important. Thursday, you can see that it's a full day manufacturing PMI data. So from 9:40 a.m., we have the HSBC PMI. The consensus is 51.5 from 51.7 from last time. So people are expecting the momentum is still there. So if you see the HSBC PMI drop, most likely Aussie will also follow drop, right? So also it was afternoon, you will see the French PMI, German PMI, and the Eurozone PMI will start to come out. So you see the market expect a very strong, a very clear fall of the German PMI. Right, German PMI last time is 52.4. Now the forecast is 51.8. It can be even lower then don't feel surprised. It just feel lower. It's very possible because the confidence level in Europe was not very high. Friday, it's the most important day, like what I mentioned, is 10 p.m. Let's hear what Janet Yellen say, because it's the message passed to everyone that what kind of monetary policy the Federal Reserve might use in the next 4 months or 5 months toward the end of the year. So that's the key data you should watch for this week. So now let's take a look on the charts. What will happen? So first charts, let's look at the euro dollar. Euro dollar, you can see that current price is 1.3383. So after we draw the Fibonacci line, you can see that before the key data, right, the price is likely to just let me zoom in the price a little bit. You see the price, just let's see the momentum first. The price is likely to stay between 1.3315 to 1.3444, but I don't see the price will go to 1.3444 this week unless Janet Yellen surprise everyone to the everyone to the downside if she's so dovish. So otherwise, I don't see the price will go here. So let's look at what kind of price we might look at to short. So we go to maybe 4-hour charts. So 4 hours charts, you can see that the price also is moving in a very tight range in the previous 1 month, right? So we can see the price at 1.34, which I draw a line here, which is still forming a very strong resistance here for the near term, right? You can see that I draw a line here about 1.34, this level. So you can see I draw a white line here, 1.34, which is still forming a very resistance here, and the trading strategy is pretty clear. Is if the price go to 1.34 and there's the fundamentals still support the euro should go lower, so it's always very good to short this price. So second, let's look at some momentum. If we look at the MACD first, so short-term MACD, you can see that white line is of course is still above the signal line, but looks like the momentum is fading. Right, you can see the white line is dropped for this MACD line, and very interesting is you look at the stochastic. The stochastic, you look at the 4-hour charts, right? It also tells you it's a pretty good price to short. The reason is you look at the K line. The K line is drop cross below the D line. It's the signal to tell you the momentum is start to falling, right? So this is the indicator tells the momentum was not so great. RSI, not too many things tells. The price is still at 51.72, but you can see the momentum is also very weak. Right, so both the stochastic and the MACD here, I draw, you see, both MACD and the stochastics tells you that the price might, start to fall from the 1.34 level. So that's the thing for the euro dollar. Let's look at the sterling dollar. Sterling, just based on the technical, you look at the 4 hours. Let's look at it. Probably we need to look at the daily chart first. If we look at the price at 2014, now the price is probably will be the sterling dollar probably would be tentatively support at 200 days moving average, right? Because you see the price seems to form some support at the moving average, the 200 days moving average. So the 200 days moving average is about it currently stands at 1.6671. So now the price is at 1.6664. So it's more about very close to moving average. Then probably there was some support there. But if you look at the momentum index, you look at the MACD, right? So the price is still the line, the MACD line is still falling, and it's still below the signal line. So it tells you, and it's still in the negative territory. So momentum is not so great. But you look at the stochastic, it's probably would tell you it's a good price to buy at this moment, just based on the technical level, right? You can see that the stochastic is at oversold period, and it seems like the white line have the momentum to the K line is has already crossed the D line, so it tells you that the momentum might start to shift to higher. Also, you look at the RSI. The RSI also near the oversold area and start to edge higher, moving to the 70, moving above the 70, the 30 line. So this is also tells you that near-term momentum for sterling, it might be a bit positive. But of course, here it's just the technical analysis, right? So we are more focused on the technical analysis. For the fundamental analysis, I will combine the story to in. The third one, we are looking at the Aussie dollar. The Aussie dollar, based on the daily chart, you can see that momentum is still pretty firm, right? It's still standing above the 20 days moving average. Why it's so firm is number one is there's no lots of draw bonding from RBA anymore after the guy draw bonding in the beginning of the July, but now it's still everything looks so fine, and the China economy is still quite stable at this moment, right? And people believe that the PBOC were doing more stimulus to support the economy. So that's the reason you see Aussie didn't really drop. So where's the price to buy or to sell? I see probably you still need to use a range trading strategy. Of course, one price I always believe at this moment 0.94 would be the resistance level and the support level unchanged. It seems like if you use this strategy to trade in the following a few weeks or days, you probably will be always get benefit. So here's the two lines I'm drawing. One is the white line, is the resistance level at 0.94. The other line you look at is always quite supported. The price level is about 0.925. So now the price is pretty in the middle, right? So probably I would look at the price maybe go to 0.93, which is also looks pretty supported in the near term. It's because there's also lots of candle trading at this area in the past 6 months. So I was still holding a buy call for Aussie at this moment if the price can go to near 0.93, and I will look at to take profit when the price go to 0.94. So if the price go to 0.94, I probably will go to short. That's based on the candle pattern and based on fundamental to say. But if we look at the MACD line, it also tells you it's a good price to buy. Why? You look at the MACD white line. The MACD white lines just cross above the signal line, although it's still in the negative territory. Right, but the momentum, it could be turn positive. And also we look at the stochastic. The stochastic is still going higher, right? You can see it's still above the K line is still above the D line. It's still going higher, so momentum will still quite remain. And also look at the RSI, it's pretty flat. So based on the MACD and based on the stochastic, these two indicators and combined with the fundamental analysis, the Aussie dollar still pretty remain firm at 0.93 level. The current price is 0.9320. So the next pair we are looking at is the dollar yen. We noticed that lots of currency pairs pretty interesting because you see the price is pretty trading near to 200 days moving average. So dollar yen now trading at 102.53. It's also at 20 days moving average. So we need to use the signal to confirm whether this line will be the support or will be the resistance level, right? So of course, based on the fundamental, dollar yen might start get a little bit lower. The reason is because the dollar might be weakening because of the Federal Reserve the Janet Yellen talking this week. So we take a look on the MACD. So the MACD line was still just go below, didn't fall. The signal line was still supported at the signal line and it's going higher. So momentum was pretty flat, not so bearish and not so bearish at this moment. So it's pretty not very clear to use these indicators. But the stochastic, it really tells you that the momentum might still go higher, right? After it cross the K line cross above the D line, now it go to 61 and it still go higher. And the RSI is in the middle. So all in all, I think dollar yen might be a little bit tough to trade for this week, right? The reason I also tell everyone that everyone is expect the Janet Yellen to speech on this Friday. If the conflicts, let's say, going to there's a conflict between the technical analysis and the fundamental analysis, the advice is to avoid to this trade call. But it looks like also if the price can go to 103 before Friday, you can also maybe looking at to short this pair, right? I draw a line here, the price, you see, at 103.1. You can see the price at this level is also pretty quite capped pretty well, right? You can see that you know, the price is seldom to penetrate above this level in the previous year. So the price might also range between 102 to 103. So now the price at 102.5. It all depends on you whether you want to long or short, and see what kind of price it will move to. Okay, so that's all for today's charts analysis. Now let's go to Mario's trade call. Mario trade call today is to short sterling dollar. The entry price is 1.7655, so sell on peak. Stop loss is at 1.68, and the first profit is 1.6710, and second profit is 1.6665. So I leave the charts here. So if you want to copy, you can just copy from here. Now let's go to the questions. If you have any questions, you can just type here. First question is from Adam. Adam is asking, could Janet Yellen be more hawkish in this Jackson Hole meeting? I think the chance is pretty low, right? The reason is because the reason is because the Fed at this moment, like I mentioned, number one is that where the rest of the central banks to be dovish, it's pretty difficult to be Fed to be hawkish by themselves. Otherwise, everything will go against them. Their rates will hike, currency will hike, then it probably will trigger some damage to the economy. So I don't see Janet Yellen has a reason to be so hawkish at this moment. Number two is, like I mentioned just now, is she just want to be more cautious and more patient to make sure the economy moving to a more quality territory. Then, you know, she will start to gradually, even very gradually, to raise the rate. Number three is now we are moving toward to the end of the QE3 session. So if at this moment she's going to talking anything, raise the interest rate, it's also very to bring the curve more steepen. So that's not positive for the U.S. economy in the near term, probably in the Federal Reserve point of view. So I don't see the very high chance Janet Yellen will shift the tone to be hawkish. Eva is asking, what do you think the lending data in China last week? Is this one-off event, or it's a slowing down signal? I think it's probably still a 1 month effect, but you cannot ignore the reason that we probably will see the demand, especially the domestic demand, start to weaken from here, and also the property price is slow. That's why you see that the data is pretty, the lending is pretty slow. But it certainly raised the expectation that the PBOC or the Chinese official will continue to make its stimulus to be carry on, you know, and at least the third quarter GDP to be released above 7.5% or around 7.5%. Then probably they will make the policy to be a little bit tightened in the fourth quarter. But at this moment, I don't see the PBOC and the Chinese official has the intention to tighten the economy. Lee is asking, I've heard about increase of short selling in US equity market by George Soros. Does this mean a strong expectation of the interest rate raised by Federal Reserve or breakdown in equity market? Okay, I didn't see why George Soros want to sell the equities market, so I never see that piece of news. But if you ask me the U.S. equities views, I would tell you that my view is it's still pretty supportive in the near term. The reason is the U.S. economic data is still pretty strong, and based on my expectation, I don't see they're going to raise the interest rate pretty soon, and probably they will only give you some signal by the end of the year But of course, you know, those kind of funds, especially the big funds, right? Sometimes they're talking about 3-year, 5-year horizon with you. So it's also very depends on what's your time frame. But the other point is, think about it. If the Federal Reserve want to raise the interest rate, they want to make sure the economy must be able to working by themselves without the help. So a higher economy, a better economy should push the corporate profit to be higher. So that should be also positive for the U.S. economy. Last note is, you know, sometimes these people are talking, they're going to sell the U.S. equities. In the end, they probably might not sell. They have their own, own plans. Or well, so this is just my view. So you can just look at what's the reason he wants to sell the U.S. equities, but you don't need to look at the headlines quite closely. So most of the time we are looking at what kind of reason she or he provides. I think that's the most important things. Okay, so that's all for today's 1 hour's webinar. So it's a very great to see you guys here. In next week we will resume our webinar. We will talk to you about the China and the Eurozone manufacturing PMI. How does that impact the market further? Of course, next week we will also talk to you about what kind of languages we hear from Janet Yellen, which is going to impact the US dollar in the near future. So good night. See you next week.